Have you ever heard of the symmetrical triangle indicator? I'm pretty sure you've seen charts showing this pattern before. In this video, I'll show you a free TradingView strategy based on the triangle indicator. Plus, I'll give you access to two strategies, a simple one and a more advanced one. Before we start, remember the difference between an indicator and a strategy. An indicator just shows information on the chart. A strategy simulates trades to test how well it would have worked in the past, or to send alerts for future trades. It's important not to trade without understanding the theory behind these tools, so I'll quickly explain what a symmetrical triangle is. A symmetrical triangle is a price pattern that happens over time. It was popularized in 1948 by Edwards and McGee in their classic book, Technical Analysis of Stock Trends. This pattern shows that the market is in a consolidation phase, meaning traders are unsure whether to buy or sell. Because of this, the price moves within a tightening range. When the price finally breaks out of this triangle, either up or down, it usually moves strongly in that direction. This breakout is what traders look for. Now, let me explain how the TradingView indicator and strategy work. The indicator automatically finds a pattern with 6 important points called confirmation points. These points get closer together over time, forming the triangle shape. Each of these points represents key levels where the price touches the triangle boundaries, which act like support and resistance lines. If fewer than 6 points are found, the triangle is not confirmed and doesn't count. The strategy uses this indicator and works only with confirmed triangles. It also includes rules for trading when the breakout happens. You have a couple of ways to decide when to trade. The traditional way: trade in the direction where the price breaks out of the triangle. Or, trade when the price crosses one of the last 2 confirmation points. The simple strategy I'm giving you uses the second method to reduce false signals. I'll also share a more advanced strategy that handles tricky situations better. I'll explain it briefly because it uses some technical terms. One problem with triangles is false breakouts. When the price breaks out one way, but then quickly reverses and goes the other way. This happens because big players in the market know where most traders put their orders and stops, and they move the price to trick them. To avoid these false breakouts, I created a strategy that tries to tell if a breakout is real or false. Here's how it works. To spot a false breakout, the strategy looks at what happens after the breakout using moving averages. If these moving averages cross, it means the price is reversing, so the strategy will open a trade in the opposite direction to take advantage of this move. To confirm a real breakout, the strategy checks if there is strong volume and momentum. It uses 2 indicators for this: volume and the RSI, Relative Strength Index. You'll find this advanced strategy for free in the video description. One important thing: these strategies don't include exit rules like stop loss or take profit. You should add those yourself based on how much risk you want to take. Because of this, backtesting results aren't real trading results. The strategy only sends alerts to open trades and never closes them. So, for that reason, when sending alerts to your automation system, you should add fixed distance parameters for stop loss and take profit. In future videos, I'll show you how I built these strategies using artificial intelligence, so you can create your own. See you next time.